Welcome back to the portfolio, everyone. And today I'm going over the top 3 stocks that I believe are going to thrive in the new stay-at-home economy. So with the economic shutdown that we went through, a lot of people and a lot of businesses transitioned to a new economy and a new way of doing business where a lot of consumers and employees are doing a lot of their business and consumer habits from home. So the new stay-at-home economy is where consumers in this new economy work, shop, socialize, and get most of their entertainment at home. This new lifestyle system is a direct result of digital access with convenience, efficiency, and sustainability in high demand. So with this stay-at-home economy, there's a couple different trends that we're going to see, and I've decided to go through 3 different companies that are actually going to thrive with these new economic conditions. So you can see with this new stay-at-home economy that we are kind of transitioning into today, more people are working from home, businesses are pivoting to direct-to-consumer models, businesses are shifting their offerings to digital, e-commerce experiences are evolving at unprecedented rates. Online shopping is moving from a convenience to a necessity. So today I'm going over 3 companies that I believe are going to grow and thrive in this new stay-at-home economy, which we're living in today, and I believe we're going to continue to live in moving into the future. The first one on the list is, of course, the e-commerce beast, Amazon. And for each of the 3 companies we have on this list today, we're going to go over the financials. We're going to take a look at how the company's income and revenue and, of course, net income has been performing over the past 5 years. We're going to take a quick look at the balance sheet as well to determine the current financial position of the company, if they have enough assets on hand to cover their liabilities, and if they'll be able to operate moving forward. And, of course, we're going to talk about why these companies are going to thrive and grow in these market conditions. But before we do that, I am going to ask if you can please like and subscribe. I'm the Gen Z investor, and every single day we come out with new videos talking about individual stocks you can purchase for your portfolios. We talk about the performance of the overall market, and as well we talk about any big news headlines that come out of the stock market each and every day. So I appreciate you tuning in, and every single day we have new content coming out in order to help you and, of course, to teach you different things about investing. So the first stock, of course, is Amazon, ticker symbol AMZN, currently trading at $2,692 a share. On the 1-year chart, you can see they are up over 41%. You can see pre-pandemic highs here. The overall market saw that huge decline at around 31%, but Amazon has clearly fully recovered and continued to grow rapidly past that dip in the market. Current market cap of the company is around 1.34 trillion, which makes it the 3rd largest company on the S&P 500, only behind Microsoft and Apple. So of course we know Amazon for their massive e-commerce website that makes up around 40% of all e-commerce sales. But another reason I really like Amazon and why I have them at the top of this list, in my personal opinion, is because they're actually diversified into a lot more than just their single e-commerce website. If you take a look here, this is a chart that shows a bunch of different products and services Amazon actually owns and all the different sectors of the digital market they're actually competing in. So you take a look here, in the green circles, all the products and services Amazon owns. So you can see here Amazon owns Twitch, that is competing in the game streaming services. You can see they own Audible, which of course competes in the audiobook sector. Amazon.com, of course, direct competes with eBay, Flipkart, and a bunch of different e-commerce websites. And of course, they have so many different opportunities and programs that operate in a bunch of different sectors across all market ideas and different platforms that Amazon is actually at war and is competing with a bunch of different companies every single day. So that diversity for Amazon is actually one of the reasons that I believe they're going to thrive. I believe companies that are one-dimensional now may not have the opportunity to grow and compete against the big boys like an Amazon or a Microsoft or an Apple. And I believe that a lot of companies have to do a lot more than just one single thing in order to survive this crazy market times we're living through. So we're going to take a look now at Amazon and we're going to go through their financial statements. The beast that Amazon is, they have so much revenue coming in, their financial statements are sure to be good. If we take a look here, their income statement, revenue in 2015 was around 107 billion. Trailing 12 months, that revenue is now 296 billion. So their revenue has gone from around 100 billion close to 300 billion in a matter of 5 years. So they tripled their top line revenue in 3 years, which is absolutely astounding. Take a look here at their net income. All their expenses, as you could tell, for a typical tech company that is in the growth stage, very normal. See a lot of R&D expense, a lot of selling and admin expense, of course, for what Amazon does and how they generate revenue. Those are to be expected. And of course, now we're going to take a look at net income, which have seen close to $600 million of net income in 2015, all the way up to around $10.5 billion of net income in the trailing 12 months. So net income has been growing very nicely year over year. With regard to balance sheet, Amazon does have a very strong balance sheet. Total current assets on hand are close to 86 billion. Meanwhile, total current liabilities are a little bit high right now at around 80 billion. So the current ratio is above 1. It's not as strong as it could be, but I do believe over the long term they will be able to improve that current ratio and get it much higher to around a 1.5 or a 2. The next thing, of course, is their total assets with regard to total liabilities. You can see here $220 billion of total assets compared to total liabilities of only around 156 billion. So a lot of total assets on hand. Over the long term, they'll have that good financial position and they'll be able to pay off all those liabilities and continue to operate very smoothly into the future. So that's it for Amazon. The number 2 stock on my list is actually somewhat of a competitor to Amazon. It is Shopify, ticker symbol SHOP or SHOP, currently trading at $910 a share. Shopify has seen a 1-year share price growth of 214%. Very similar price growth as Amazon. You can see they saw the overall market dip and it has fully recovered and grown very nicely past those pre-pandemic levels. Very small market cap with regard to Amazon, and in comparison, Amazon had a close to $1.34 trillion market cap compared to the market cap of just over $100 billion for Shopify. So a much smaller company with comparison to Amazon, but not a small company overall. So if you don't know what Shopify does, Shopify is actually a platform where if you or I or any individual or company wants to create a digital website and online e-commerce store, we can go on Shopify, pay a monthly premium or monthly subscription fee, and actually generate and create an online digital store that we can sell our products or services directly to consumers across the globe. So that they're that platform that allows individual consumers or individual businesses create websites and sell their products to anyone across the globe. And they create a monthly fee. Of course, they do sell other products, but of course, that is their core business. We're take a look now at their financial statements. Of course, Shopify is completely in the growth stage. They're all about reinvesting their money and growing their business as fast as possible. You can see here in 2015, their total revenue was around 205 million compared to the trailing 12 months at 1.7 billion in total revenue. So revenue has completely grown extremely nicely over the past 5 years. Net income is a little bit different compared to Amazon. You can see here they actually have a net loss over the past 5 years in each and every year, and that net loss is actually growing. So as the company is generating more revenue, they're using all that revenue and a little bit extra in order to refund and grow the business. So they're throwing a lot of money into research and development in order to improve operations, create new and innovative products to actually grow and compete with the big boy such as Amazon and a bunch of other e-commerce websites and platforms across the world. So the next thing is their balance sheet, which Shopify is an extremely strong balance sheet. So with a tech company that is growing revenue and investing all that money back into the business, you want to make sure they aren't carrying a lot of debt because that will eat into the amount of money they have to actually grow the business if they're spending a lot of it paying off debt. So Shopify has a beautiful balance sheet for a nice growing company. You can see here they have total current assets at around 2.7 billion. Meanwhile, their total current liabilities are only at 288 million. So a lot more current assets and current liabilities. Very beautiful current ratio. They will pay off all those current liabilities with no issue and continue to operate very nicely in the short term. Overall, in the long term, you can see close to $3.5 billion in total assets overall, compared to total liabilities at just 430 million. So once again, very strong financial position for the long term as well. Tons of total assets. They can pay off all their total liabilities and continue to grow the business very nicely. Another thing that Shopify was actually in the news recently because they did partner up with Walmart in order to try to compete and kind of grow together against Amazon. So they made an agreement and a new partnership with Walmart that could strengthen both companies and actually help them defend against Amazon. And this deal is somewhat a little bit complicated between what these parties are each going to do for each other. If you want to go in depth, leave me a comment. I will make a video about this deal in depth. But we're going to jump right into the third stock on this list and the third company that I believe is going to thrive in a stay-at-home economy, and that is Prolongis, ticker symbol PLD, currently trading at just under $90 a share, $89.83 per each individual share. On the 1-year price chart, you can see it's up close to 15%. Market cap at around 66 billion with a current dividend yield at around 2.6%. So this is actually a real estate company. If we take a look at the company description here from Yahoo Finance, you can see Prolongis is a global leader in logistics real estate with a focus on high barrier, high growth markets. They own and operate around 965 million square feet in 19 different countries. Prolongis leases modern logistics facilities to a diverse base of approximately 5,500 customers, principally across two major categories: business to business and retail/online fulfillment. So these are two categories that I believe are going to continue to grow. Businesses will continue to operate and buy from other businesses, and the retail/online fulfillment center need is only going to grow moving forward. As we shift to more of a stay-at-home economy and individuals become more comfortable with purchasing goods and services online, this need for retail/online fulfillment centers is only going to grow moving forward, and I believe this puts Prolongus in a great position to not only grow operations but grow income and earnings each and every year. Prolongus actually does pay a nice dividend at around 2.6%, which I believe is going to continue to grow with this new growth in earnings and revenue coming from this, overall need growth for fulfillment centers. Taking a look here at the income statement, revenue has grown beautifully year over year. 2015, they had around $1.5 billion in rent revenue. Overall total revenue in 2015 was around $2.3 billion, which has grown all the way up to around $3.769 billion in total revenue in the trailing 12 months. Even during this economic slowdown, you can see from 2018, 2019, in the last 12 months, revenue has actually continued to grow and they did not see any dip in revenue. Net income follows a nice trend as well, growing each and every year. You can see net income going up very nicely on that nice upward trend. Overall, the balance sheet, you want to make sure that as a real estate company, it is not easy for them to, of course, liquidate a lot of their assets, but you want to make sure that their debt and their liabilities is not too high. They want to make sure they have more assets than liabilities as you would with any other company out there on the market. You can see here they have total assets around $55 billion. Meanwhile, they have total liabilities at only around $18 billion. So once again, huge quantity of total assets that can pay off all their total liabilities and continue to grow the business moving forward. So I do believe that puts them in a strong financial position, not only in the short term, but as well in the long term. The last and final thing we're going to take a look at for this company is, of course, that dividend. As a dividend growth investor myself, I like to have companies in my portfolio that have the ability to grow their dividend for the long term, and each and every year when we see that nice dividend increase that is not only sustainable, but safe moving forward. Current yield at around 2.6%. Annual dividend payout at $2.32 per individual share. Very safe payout ratio at around 65%, with beautiful close to 10% average annual dividend growth rate over the past 5 years, with a 7-year dividend growth streak. I do believe they're going to continue to grow that dividend moving forward, and this could be a company you may want to add to your portfolio right now if you need to increase your real estate sector. So that was the third stock that I believe is going to thrive in a new stay-at-home economy. So if you believe we're going to transition into a stay-at-home economy, by all means, do some research into Amazon, Shopify, or PLD. These are companies that I believe are not only going to grow and continue to thrive, but actually reach new highs with this new stay-at-home economy. So if you appreciated the video today, I do appreciate if you like and subscribe. I am the Gen Z Investor, and every single day we come up with new videos that talk about different stocks you can buy and the overall stock market. So I appreciate you for tuning in, and I will see you in the next one.